So let's go ahead and kind of move on to our next guest, who literally I don't think needs any introduction. Everybody knows John Bollinger, one of the I'd say founders, one of probably the most influential characters in technical analysis. I have a great privilege to work with him. Everybody's pretty familiar with John Bollinger and Bollinger Bands. And particularly, we're very excited to bring him in here today. So, John, what I would like to do is see if we can hear you. I see your mic's on.
I don't know. Can you hear me?
Oh, wow, I can hear you.
There you go.
We're doing, and I promised you the audio would sound pretty good. You sound awesome.
Oh, perfect. Thank you so much.
What I'm going to do, is there anything you particularly want to say as we're getting started with you? Do you have anything to say for yourself?
No, just that I've been at this for quite a long time. And I have some interesting things I think to share today. Let's see. I'm sorry if I'm hesitant here. I'm trying to get this technology going on my end. Is there anything
I can see a picture of your wife Dorit Dorit, and I think you're probably behind a dialog box. Do you have a? There you go. All you had to do is hit full screen now, and we should be able to see it.
Okay.
So we can see the non-expanded version of your PowerPoint. And now it's perfect.
Okay. And let's see. Let me get the little spotlight here so that I have something to mouse around with. Can you see that?
Mm-hmm. Yeah. So far we're rolling 100.
So I'm good to go then.
Yeah. And I will get out of your way. Let's go.
Well, good morning, everybody, or afternoon, as it may be, wherever you are. Thanks for spending a bit of your Saturday with me. I know weekends are precious to most people. I'll try to make it a rewarding experience for you. I have a very long history with MetaStock. I've been using the product all the way from the very first versions, which were actually DOS versions in the old times. So I've worked with these people over the years. We've developed toolkits, first the Bollinger Band Tool Kit, and then the Bollinger Band Tool Kit version 2, which we're just releasing this year. I want to shout out to William Golson and Jeff Gibby, who helped me develop it. Without them, I couldn't have accomplished what we've accomplished. I'll show you a little bit of the toolkit today, but we're going to start with an overview of what Bollinger Bands are, how they work, what they're useful for. We won't have time today to go into anything in great depth, so I just want to kind of give you the landscape of how Bollinger Bands were developed, what we were thinking when we developed them, how we used them, and then how we've integrated them into the MetaStock package to allow you to reap the full power of this approach. So without any further ado, let's start. We're going to talk a little bit about charting and how to put together the optimal chart for using Bollinger Bands. And I thought this first slide that I thought I would be able to do away with this slide years and years ago. All of this software that we have today draws beautiful charts and incredibly detailed charts, but as more and more people have moved to trading on phones, the line chart has come back, and I really urge you, if you can, to look at something better than a line chart. A line chart simply obscures too much information. Normally, I would start this presentation with a picture of a line chart, but I'm simply going to skip it because we want to focus on the highs and lows and ranges as part of our information. I think price bars do a much better job of depicting the price formation mechanism on the screen. And that's, after all, what we're after with technical analysis, is an understanding of the price formation mechanism and how prices are being developed in the current time, so that we know what our risk-reward ratios are and where our opportunities lie. So here's a basic MetaStock chart of the price bars. And this will be our base chart as we go through. Each period is one day. I'm going to use daily charts here today, although the tools that we have built are applicable to very short-term charts, 1 minute, 5 minute, 10-minute, hourlies, dailies, weeklies, all the way on out to quarterlies and yearlies in some applications that I've seen. For me, the sort of optimal time frame is the daily chart. It's the environment that I grew up in. I sort of use dailies as my main reference. When I want a shorter time frame, my first choice in a shorter time frame is generally an hourly chart. And when I want a longer time frame, my first choice is generally a weekly chart. So each bar here has a tick to the left, which shows the opening price, a tick to the right, which shows the closing price, and then the range is from the high of the bar to the low of the bar is the high of the day, or to the low of the day. And I like to emphasize that relationship between the open and close. I think it adds a lot of value. So I like to switch from bar charts to candlestick charts. And candlesticks highlight that all-important relationship between the opening and the closing each day. In fact, if you go to Japan and you ask somebody the price of a stock, they'll give you the last price, but the change that they give you won't be from yesterday's close. It'll be from today's open, because that's what they feel is the most immediately relevant piece of information. So by switching to Japanese candlesticks here, I think we pick up a lot more visual information. The red bodies are candlesticks in which the close was lower than the open, and the green bodies are the candles in which the close was higher than the opening. By the way, this chart that we're going to use today is of QQQ, one of the most popular ETFs, and the base instrument for our icebreaker trading system. So the thing that I really like about the presentation of candlesticks is it really highlights the balance between buyers and sellers on these upthrusts that you see on this chart. And unfortunately, we've had a pretty much a one-way market for the past year, pretty much straight up with a few corrections and a few consolidations. But as you can see during the advances, it's dominated by green candles. So you understand that each day the price is being marked up during the day and it's closing higher than it opened. And then inevitably the consolidations are dominated more by red candles, and you can immediately get a visual sense of what's going on there. So what we're going to do is we're going to keep on adding pieces to this chart as we go along until we get what's an optimal chart for Bollinger Band analysis. The first thing we're going to do is we're going to add a measure of trend, and we use a moving average to discover which way price is going. 20 periods is a good starting point. When I started in this business, we used to use 21. I settled on 20 as it's seemed to me to be a little bit more accurate. But the truth is that almost any average between, say, 18, 19, 20, 21, even 22, they all serve the same purpose. And as for U.S. stocks, they give you a view of what's happening in the intermediate trend here. Here, this blue line is a 20-period simple moving average. And we'll discover in a couple minutes that not only does it serve as a measure of trend, but it will serve as the base for the Bollinger Bands. And if you notice that during the consolidations, it either tends to flatten out or turn down a bit, but that during most of the uptrends here, it's pretty steadily up. And that is, in fact, our definition of an uptrend, is when the value of the 20-day moving average today is higher than it was yesterday. It seems like a very simple rule, and it is, because we want to highlight the basics of the market. We're not trying to get very sophisticated here. We just want to have a sense of whether prices are rising on average or whether prices are falling on average. You can get fancy about this and add a bunch of other rules, but for us, this basic idea works very well. And often what we'll do is we'll actually color the moving average. When today's value of the moving average is less than it was yesterday, we'll color that section of the average red. And when today's value of the moving average is higher than it was yesterday, we'll cover that section of we'll color that segment of the moving average green. And that way it really highlights whether we're rising or falling. So we have here a basic definition of trend, and that will be essential to everything that we're going to talk about today. So the moving average is selected to define the direction of the intermediate term trend. It's usually longer than the best crossover average. For example, for many stocks, an average of 8 or 9 or 10 periods is a decent crossover average, and we're using an average of 20 periods, so it's double the length that one might use for a crossover. And that's because we're looking at it not for signals when price crosses above it or below it, but as a useful definition of trend. So when the average is rising, the trend is up, and when the average is falling, the trend is down. Just as simple as that. The most basic measure of supply and demand is volume, and we are going to add volume to the chart as our next indication. So we're going to start building up the chart here, and the first piece that we've added here is in a clip at the lower portion of the chart, and it's a histogram of volume where each bar represents the amount of volume that was transacted in that segment. The question, though, is how do we know whether volume is high or low? And we're going to use a moving average for that. I'm going to just plot, in this case, I plotted a 50-day moving average, and we can now define a very simple idea. Volume above the moving average is high, and volume below the moving average is low. And you're going to see that we're going to do the same thing for price that we're doing for volume here in a little bit in constructing the Bollinger Bands. What we're going to try to work for is a definition whether price is relatively high or price is relatively low. So we can improve on that by a simple little mathematical transformation to create an indicator I call normalized volume. So what we're going to do is, in mathematical terms, we'd say we're going to normalize volume relative to its moving average. And all we've done is divide volume by its moving average and multiply by 100. So now we have a little bit better environment to understand what's going on here. So we can say if volume is greater than 100, volume is relatively high, and if volume is less than 100, volume is relatively low. So here's the formula that we used for that. It's just volume divided by its 50-day moving average times 100. And in normal terms, we say that normally we just say if volume is 100 is high volume and volume less than 100 is low volume. But I think we can come up with a better definition. We can use a threshold. We can say normalized volume greater than 125 is actually relatively high volume, and normalized volume of less than 80 is relatively low volume. And that area between 80 and 125, we call that normal volume. And so here we've drawn those bands here, and I think it provides a little bit better information that is more useful than the crisp single value of 100. Here we have acknowledged that there's some times when volume is simply normal, there's sometimes when volume is high, and there's sometimes when volume is low. This is going to be very useful as we move along, as we compare price action to volume. So the next step is we're going to look for a way to apply this same sort of normalization that we applied to volume, but we want to apply it to price. But price is open-end where volume is anchored. Volume is always anchored at zero. Although it can expand for some of these stocks to very high levels, it's always going to have a zero reference line. But price does not have such a reference line. It's open-ended. So we need to choose a different sort of approach. So first we'll employ our moving average, and then we'll look for upper and lower limits above and below that moving average. And along the way, we will find Bollinger Bands. Then we can let those limits define whether price is relatively high or relatively low. In order to do this, we're going to create intervals above and below the average, and we're going to create those intervals using a measure of volatility, which we call standard deviation. It's the most common measure of volatility. Some people have suggested modifying Bollinger Bands by using other measures of volatility, and in certain circumstances, those ideas are useful. Mean absolute deviation has been suggested by several people. We find that for the sort of trading that we do, the sort of trading setups that we're looking for, standard deviation is a more robust and dynamic value. So we've stuck with standard deviation over the years, but there are some other definitions of volatility that people have used. So here we have Bollinger Bands. The red line is the upper Bollinger Band. The green line is the lower Bollinger Band. The blue line is that same moving average that we were talking about before, the 20-period moving average. And together, these three curves form the phenomenon that we know today as Bollinger Bands that define relatively high and relatively low on a relative basis. So here's the basic definition of Bollinger Bands. I have put virtually all of my work over the years into the public domain, and I released Bollinger Bands into the public domain very shortly after I created them. So there's no secrets here about how they are constructed. The middle band is that moving average. The upper band is the middle band plus width, which is a variable, times volatility. And volatility is the 20-day standard deviation. It's the standard deviation of the very same data that was used in the moving average. The defaults here are 20 periods for the calculation of the moving average, and the width, the default is 2. So for the standard deployment of Bollinger Bands, it's a 20-period moving average. For the upper band, it's that moving average plus 2 times the standard deviation. For the lower band, it's that moving average less 2 times the standard deviation. Now, a lot of people like to change these values up. Perhaps the most popular change is to dramatically shorten them down to 10 or 12 periods and to tighten the bands somewhat. For very short-term traders, this is a very popular approach. Another popular approach, variation on this theme, is to plot more than one set of Bollinger Bands, to plot not just 2 times the volatility, but to plot 1 times the volatility, 2 times the volatility, and 3 times the volatility. So you can see that there are a lot of different ways that you could deploy these bands, but we're going to focus today on the basic deployment. So again, here the defaults we're going to use today are a calculation length of 20, and it does not matter whether it's days, 5-minute bars, 10-minute bars, hourly bars, weekly bars. It's always the same idea. The default length is 20 periods, and the width is 2. So this question comes up time and time again. Why do you use standard deviation as our volatility measure? And it's because it has a very special property. It emphasizes the outlying prices. And that's because the deviations from the average are squared inside the calculation. You remember from high school math, if you square a small number like 1 or 2, you get another relatively small number like something in the range of 1 to 4. But if you square a large number like 10, you get a very large number like 100. So when prices start to distance themselves from the moving average, the internal mechanics of the standard deviation calculation pull those deviations in and expand them dramatically. And that keeps our definition of relatively high and low germane to the price structure as it develops. And that's absolutely key. And that means it's very sensitive to breakouts and very adaptive to changes in the volatility regime. And that's what makes the band so dynamic and useful. So Bollinger Bands define whether price is high or low on a relative basis. Now, I'm going to put you on the honor system here since I can't hear you, but I want you to repeat after me the next two sentences. And just say them out loud because they're so important. So Bollinger Bands are high, prices are high by definition at the upper Bollinger Band. Good, good. And prices are low at the lower Bollinger Band. Good, because those are the two most important concepts behind Bollinger Bands. Prices by definition are high at the upper band and by definition are low at the lower band. If you get that, then the rest of the pieces fit together really easily. So what we're going to do here is I wish to illustrate a basic Bollinger Band idea. When we started years ago, what we were doing is we were using percentage trading bands. So we would draw a 21-day moving average on the chart, and then we would shift that moving average up by 4 or 5 or 6, 7%. It depended on different values for different securities. But for like the Dow, for example, we would shift it up about 4.5%, and then we'd shift that same average down 4.5% to form a price channel. And then we would take an indicator, like the indicator we have plotted on the bottom of this screen, and we would compare price action within those bands, within those channels, to the action of the indicator. And if we went up and tagged the upper channel and the indicator were negative, we would take that as a sell signal. If we went up and went down and tagged the lower channel, then we would, and the indicator were positive, then we would take that as a buy signal. Now, it's really been a one-way market over the past year, so we're not going to generate any sell signals here, but we generate a lot of buy signals here. So the first one comes over here. We pull back for a couple of days and we have a sharp down day, and the indicator is very strongly positive. So when you tag, you can get outside the lower Bollinger Band right here. It's a pretty strong buy signal. You come back and retest it. You're back to neutral, but not negative, right? And then you get this big rally. And again, you get another pullback here and another pullback. And each time you tag the lower band here, we tag it 1, 2, 3 times. The indicator is positive. So those are all buy signals. And again, it's echoed over here when we tag the band once here and once here. The indicator is again positive. So those are buy signals. Again, we see it here and we see it here. In a less dynamic market, a less one-way market, you see both of these ideas much more frequently. You see buy signals clumped up and you see sell signals clumped up together. It's unfortunate that the market hasn't given us some examples of sell signals here. Every time we tag the upper band here in the past year, the indicator was always positive. So we never got the sell signal, but we got 1, 2, 3, 4, 5, 6. Should we call it 6? Buy signals here. Now, in an uptrend like this, we don't actually call those buy signals. We call them as confirmations because we're in such a strong uptrend. But if we're coming down and then we start to get signals like that, those are the initial buys, and then the subsequent signals are confirmations until we get a signal in the opposite direction. So in order to go any further, I have to introduce you to a couple of the indicators that are derived from Bollinger Bands. And the first one is %B. And it's also the first Bollinger Band indicator that I ever programmed in MetaStock, and it's part of the MetaStock Bollinger Band Tool Kit. %B tells us where we are in relation to the Bollinger Bands. So %B, the formula here is the last minus the lower band, divided by the quantity of the upper band minus the lower band. Those of you who are familiar with technical analysis and the history of technical analysis and how some of these indicators are calculated will recognize very quickly that this is a variation of the formula for stochastics. And that's not by mistake. I'll come back and talk about stochastics a little bit later when we talk about 3 pushes to a high. But I just took the formula from George Lane for stochastics and plugged in the upper band and the lower band where he had used the periodic high and the periodic low. So %B is essentially a version of stochastics using Bollinger Bands instead of periodic highs and lows. So here we have %B in the lower clip, and you can see that just as stochastics, it ranges from 0 to 1. But the difference with stochastics is we can get outside of the upper band. So %B can be a number greater than 1 when we're above the upper band, and we can get outside the lower band. So %B can be a number less than 1 when we're less than 0 when we are outside the lower band. And I just want to point out to you one little beautiful setup here. This is a W bottom in %B. You can see it right here in the middle of this consolidation. If you recall from the previous slide, when we came down and tagged this lower band twice here, the indicator that I used, oh, and by the way, that indicator was intraday intensity. It's a volume indicator, and it's included in the Bollinger Band Tool Kit. It was developed by David Bastian. If you want to read the article about it, it's included in the Encyclopedia of Technical Indicators that was published by Tradecraft. But we've programmed it for you and calculate it for you in the toolkit. So with the indicator positive, 2 confirmation signals, one right here and another right here, and a divergence in %B, then we take this as this first day up as a strong buy signal, and it leads into this big rally. So this is a very important setup in terms of Bollinger Bands for us in terms of forecasting what the future price action is going to be. Note that when we come down and retest, as you often do in an uptrend, that we're not able to actually get outside the lower band, whereas in the initial setup, we were able to get outside of the lower band on both sides of the W pattern. You can clearly see the capital letter W in here. So %B has a lot of other uses. It's very useful in pattern recognition. It's very useful in systems trading and such like that. But in order to, we have such a short amount of time together today that I need to move on to the next indicator, and then I'll show you how to combine them. So the second indicator that I ever created for Bollinger Bands and the second indicator I programmed in MetaStock was bandwidth. So bandwidth simply tells us how wide the Bollinger Bands are. It can be compared across time, and it can be compared from issue to issue, but the comparison is most important across time. It's simply the distance from the upper band to the lower band divided by the middle band. So bandwidth is most useful in identifying trading opportunities. And big trading opportunity is the squeeze, and other trading opportunity is the bulge. So the squeeze is a trough in bandwidth, a relatively low value in bandwidth, and a bulge is a peak in bandwidth, a relatively high value in bandwidth. So a squeeze is a forecast for increased volatility, and a bulge is a forecast for decreased volatility. But it's more important to think about it this way. A squeeze is the beginning of something. A squeeze is a condition in which trends are born, and a bulge is the end of something. It's the place where trends go to die. And you'll see that on a chart as we go forward. So these concepts of squeeze and bulge are very important. So we see right here, we have a bulge. We come up and tag this upper red line, tells us that the bandwidth is relatively high. So this tells us that this trend that was in place before has ended here. And then as this W develops, confirmed both by intraday intensity and by percent B, we come down and we make a squeeze here. Bandwidth drops from 9 all the way down to 2.5. So this is a very large decline in terms of bandwidth. So we have a squeeze developing here at the same time the W is forming, and that leads to this very big expansion that we have here. Note over here that we have a bulge and we've just turned down from it, suggesting that the market may be thinking about topping here. I would think that what will happen here, most likely, because the market internals are so strong, and this chart is up through Thursday, by the way, not up to date. But I would guess that what will happen here is that we'll have a little bit of a consolidation before we can continue higher. The rest of the market is so strong and the internals are so consistent that I wouldn't think that this is going to be a market top. At most, I think this is going to usher in consolidation. So let's clean up and put it all together. You can get rid of the window decorations and such. So we're going to put Bollinger Bands, percent B, bandwidth, and normalized volume all on the same chart. We're going to right-click on MetaStock chart, and under chart window properties, we're going to say we're going to uncheck the box that says show inner window title bars. And this is the sort of presentation that we're going to get. So this is the basic Bollinger Band chart. We have Bollinger Bands, percent B, bandwidth. The only real variation that we use on this basic chart setup is sometimes instead of using normalized volume, we like to print that indicator that I showed you earlier, the confirmation indicator, intraday intensity. I prefer to use normalized volume for this reason. Look at this downturn here, right? We turned very, very high volume. And then when we come back to tag and set up for the next move here, we're turning much less volume. So I really like to study these relationships, and I think they're very important. So normalized volume is my first choice, but I often like to flip it out with intraday intensity. But this is our basic visual display for visual traders that want to trade chart patterns and set up squeezes and bulges with Bollinger Bands. With MetaStock, they have an expert that overlays on this and picks out all the important relationships, bulges and squeezes, breakouts, breakdowns, and the 4 trading methods that we use that are packaged in there are all integrated into that expert. So you have a very dynamic environment for those of you who are familiar with how to use those MetaStock experts. Not only do you have the basic trade setup easily accessible to you, but you have this expert highlighting places that you really want to focus your attention on the chart. So in order to go any further, I would talk about some of the new indicators that are in the Bollinger Band Tool Kit for MetaStock, and then we're going to focus on just one of them. What I did is I created a taxonomy of technical indicators: supply-demand indicators, volatility indicators, overbought, oversold indicators, impulse strength indicators, so on and so forth. I made a dozen categories or so of technical indicators and organized all the classical indicators into them by the tasks that they were most frequently used for in trading. And then I went and created a Bollinger Band indicator derived from Bollinger Bands in each of the areas so that I had a logically consistent set of indicators to use that were all of a piece, that all worked together. So in the supply-demand area, I created an indicator called BB accumulation. For changes, to focus on changes of volatility, we have an indicator called bandwidth delta. For impulsive moves, Ian Woodward always favored analysis of very impulsive moves. And so we created an indicator basically with him in mind, which we call BB impulse. It focuses on short-term strength. And then we have BB index that focuses on overbought and oversold. We have a momentum indicator called BB momentum, which gives you volatility scaled momentum. And BB persist, which is a long-term trend indicator. It gives you some sense of how price is developing over the intermediate to long-term. And then finally, BB trend, which focuses on the trendiness of the markets. That is the indicator that we're going to focus on this afternoon, because it's the third indicator after percent B and bandwidth that we're going to use in analyzing a sort of classic Bollinger Band trade setup called 3 pushes to a high. So BBTrend is a trend indicator that couples trend and direction information. It's quite similar to the sort of indicator that directional movement or ADX is. It's sort of in the same indicator space, but it's derived entirely from Bollinger Bands. So it compares Bollinger Bands of different lengths, typically 20 and 50 period Bollinger Bands, but you can adjust that to fit your trading style. So what we find is that in a rally, the upper Bollinger Band tends to coincide with the upper Bollinger Bands tend to coincide, and the lower Bollinger Bands tend to spread apart. In the decline, exactly the opposite happens. The lower bands tend to fuse together, while the upper Bollinger Bands tend to spread apart. So we just plug those into a mathematical formula and to try to extract the trend information from them. And in the consolidation, what you'll find is that there's an equidistant amount of space between the upper and lower Bollinger Bands. So here I've drawn 20 period and 50 period Bollinger Bands on this chart. And the 50 period Bollinger Bands are the blue ones, and the 20 period Bollinger Bands are the red ones. And you can see that during up moves like this, they tend to run very, very closely together. And that's the essence of BBTrend. And during downtrends, you can see that if this downtrend had continued, these would have merged together into a downtrend. But you sort of get the idea. Again, it's been a one-way market, so we can't really examine what these look like on the downside here. But during these uptrends, you can see that they just march together pretty much in lockstep on the other upside, and the lower bands tend to run pretty wide apart, and that's the information that we plug into the BBTrend formula. So this is what BBTrend looks like over time, and it combines both trend information and directional information. When we get little troughs, that's an indication that there's some weakness in the trend. When you get big peaks in it, that's some indication that there's a lot of strength in the trend. What we like to focus on is not the absolute levels, it's the turning points that are important for BBTrend. It's these peaks. Here you see we've been in a strong uptrend, and trend turns down, we get a consolidation. Again, here we've been in a strong uptrend, turns down, consolidation. Again, an uptrend turns down, consolidation. Uptrend here turns down, and we get a consolidation. And it's true here to a much lesser extent, because again, it hasn't been a dynamic. But these, when you've been on the negative side and they turn up, it's pretty important information. At least it can be in a two-way market. In a one-way market, it's not going to add much value to your analysis. So we're going to look at a classic Bollinger Band trade setup. I have 11 minutes left, and I promised to give Jeff a few minutes. So we'll march through this in a little bit faster than we might if I had really a few hours to spend with you and go through this in detail. But the concept is very old and deep. George Lane taught it to me in a seminar using stochastics. It's a first principle of the market. R.N. Elliott saw it. It's the basis for the Elliott waves that he created. George Lane saw it. he commented on it extensively using stochastics. I saw it in terms of Bollinger Bands, and now you can see it too. So here's our chart. What I've done is I've changed the bottom indicator out. So we have 3 indicators here. This is normal Bollinger Bands on the top. The stock here is an ETF, GLD. It's the gold bullion ETF. The first indicator on the chart is %B. The middle indicator on the chart right here is bandwidth, and the lower indicator on the chart is BBTrend. And we use 3 indicators to diagnose 3 pushes to a high. The first indicator, we look for tags of the upper band, which we see here, and that produce lower peaks in %B. We want to see 3 tags of the upper band. In this case, the third tag is a failure. The first tag is the strongest, the second tag is weaker, and the third tag is a failure. So we want to see 3 tags coupled with lower peaks in %B. So, but how do you pick the second tag? It's obvious how to pick the first one, right? It's just a breakout of the Bollinger Bands. So there's number 1, we draw a line there. How do you pick the second one? Well, the way you pick the second one is by looking at bandwidth. And when bandwidth turns down on the second peak. So that's not here, it's not here, but it's here. You get a peak outside the upper band in terms of an intraday excursion, but it's a lower peak in terms of %B, and bandwidth turns down. So we know that we have the second push. So we're 3 pushes too high. 1, 2, 3. How do we get to the third one? Well, for the third peak, we want to see bandwidth at a lower level, and we see that. We want to see %B at a lower level. We see that. We want to see finally BBTrend peak and turn down, and we see that. So here you have the third push. So 3 pushes to a high is a classic Bollinger Band setup. We used 3 different Bollinger Band indicators, all of which are available in the toolkit, and we use them each to identify the 3 different peaks. For the first peak, we look at %B. For the second peak, we define the second peak with bandwidth, and we define the third peak with BBTrend. And you can see that it's a top in the market, and you get a substantial declines. So 3 pushes too high is a very important Bollinger Band technique. And within the Bollinger Band ecosystem, it provides a powerful template for market analysis. You can actually swap the pieces out. You can use some other indicators in there to try to analyze these markets. We know that when markets top, it's a much more painful, prolonged process. Whereas when markets bottom, it's a much slower, it's a much faster, much more clearly defined, sharply articulated process, whereas tops tend to be more diffuse. So at bottoms, we focus on W bottoms and V bottoms, and much sharper type of analysis, quicker, much more clearly defined. For tops, we have these more diffuse processes that help identify the shift from a bullish environment to a bearish environment. So I just wanted to point out one last thing about the toolkit here is the real power of the toolkit for me is these incredible explorations. And here you see an exploration I did Friday. I just looked for stocks that were in a squeeze because I think that the market's going to continue to go higher here. So I'm looking for stocks that are starting to develop some compression as a screening list for some stocks that I want to buy when the market starts up again. And I chose the S&P 600. It's the S&P Small Cap Index. It's the section of the market that's been lagging in this rally. And I think if the rally is going to continue, it's going to have to focus on these smaller stocks again. So I wanted to generate a list of small stocks that were in a squeeze as a candidate list to start shuffling through to look for items that I might want. So all I did was go in here, check BB squeeze, and then check the S&P 500 in the index. Listen, all the rest of this was left to the standard defaults in the exploration. And here are the stocks. There are a dozen of them, and I sorted them by percent B because I wanted to see what was happening. So we have Varex is the first VREX. It broke out yesterday and is trading above the upper band. Then we have two more stocks that are trading above the upper band, UFPI and BLKB. And then the rest of them are arrayed with, interestingly enough, we only have three stocks that are trading below their middle band. That's DHI Group, Monarch, and Aegeon. And none of them are materially below the middle band. We call the value of percent B when a stock is at the middle band is 0.5. So, this tells you how strong this market has been. So that even in the squeeze, we found 12 small cap stocks that were in a squeeze, and not a single one of them is even in the bottom, near the lower band or outside of the lower band. So there's so much more in the toolkit. We just don't have time to go through it all today in this hour. There's volume indicators, there's experts, there's systems, there's 4 methods, there's exponential Bollinger Bands and Bollinger envelopes, which are Bollinger Bands defined for stocks, for things that don't trade with a normal session. Like there's been a huge amount of crypto information in Bitcoin, Litecoin, and Ethereum, and stuff like that. We use Bollinger envelopes for those cryptocurrencies because they don't have a well-defined trading session. They trade in Asia, then in Europe, and then in America. Basically, trade 24 hours a day. So Bollinger envelopes focus on the highs and lows, so they're included in MetaStock as well. So we call all of this package Bollinger Band Tool Kit 2. We just finished developing. Again, a shout out to William Golson and Jeff Gibby, who helped me develop it. Without them, I couldn't have. Looking forward to your feedback as you use this toolkit. We'll continue to incorporate some of your feedback into it, and we'll continue to modify it as we go along and push those changes out to you. We have an informational website, BollingerBands.com, that you can visit. It's the home of my newsletter, the Bollinger Band letter, where we write about Bollinger Bands every month, and a weekly hotline. And if you have any questions, you can email me at bbands@bollingerbands.com. We'll be happy to take up your questions. And now I hand you back to the tender mercies of Jeffrey Gibby.
I'm just typing this in the chat box. John, there's a couple of comments that I want to read to you. Nikolitsa from Greece. You can hear me, right, John?
I can.
Okay, I just want to make sure. Nikolitsa from Greece says, Bollinger Bands is thousands of light years the most useful indicator for Forex. I want to thank John Bollinger for his donation to traders.
Well, thank you for that. And I just want to say one thing about that, really quick. It's true that Bollinger Bands are very useful for Forex, and it's because there's actually a reason for that. There's a statistical reason for that. Bollinger Bands, Forex are pairs trades. You're long one item, short the other. Long the Japanese yen, short the dollar, or euro, what have you. It's always a pairs trade, and pairs exhibit a statistical property called stationarity, and that's what makes them work so beautifully with Bollinger Bands. Bollinger Bands sort of have an extra bit of love in them for time series that exhibit stationarity, and that same thing is true for crypto coins.
Somebody actually mentioned that you sound like Bobby Axelrod. I'm not sure who that is, but he says he loves you even more because of it.
Bobby Axelrod, is that I don't know. Is that one of the lead singers in one of those groups or something?
I'll have to look it up on YouTube later. But
my assistant's looking it up right now. So We'll find out.
He also also a lot of really good feedback. Ron says a very good and helpful session. Um, Great job today, John. Really appreciate your coming
Well,
in and
thanks.
doing
We
that.
always try to focus on teaching you something rather than just talking about what the opportunities are with our products, so that whether you choose to use the toolkit or not, you go home with something that you can use, and hopefully it increase their trading performance regardless of your choices.
Okay, awesome. Thanks, John. Going to kind of go ahead and take over the screen share. I wanted to show you guys today just kind of one of the examples. Today, I really didn't prepare for this at all. I opened up the Dow Industrial Average. If you know much about kind of me, I like to follow ETFs quite a bit. And this is not a signal I got back in that I got into back here. But if you would have been following just one of his methods, the method 2, it would have gotten you an entry signal right here. You'll notice in his commentary, this is just one of the 4 pre-built methods that are in the system. And I've got a complete list of just how huge this thing is. But you'll notice right here, it gave a sell signal. It gives you daily updated stops, whether you want to use Bollinger stops or chandelier stops. It gives you instructions on how to get into the trade and that kind of stuff. But to kind of give you an idea, and we really don't have time to talk about all of this stuff because it is fairly massive. But where is my PowerPoint? It should be right under here. Okay, good. All right. The indicators that are included in the toolkit, this is just a list of them. I'm not going to read them off to you. This is a list of the indicators you get. If you're familiar with John or his work, he's got a book I'd really recommend. It's called Bollinger on Bollinger Bands. This includes all of the indicators he talks about in Bollinger on Bollinger Bands, as well as a bunch that he's developed over the last couple of years. In addition to that, you do get these scans. So if you want to find stocks that are up above the upper band, or back in the bands from being above them, or back in from being below, or maybe you want to find stocks that have like a bulge or a squeeze. They all have these pre-built scans that you can run against whatever you're interested in, whether it's futures or Forex, or maybe it's optionable stocks, maybe it's ETFs, whatever you want. With MetaStock, what you'll be able to do is you'll be able to scan any of 191 stocks to find these specific conditions that are in there. I just noticed I have bulge on here twice and I have squeeze on here twice. So I just realized that actually. In any case, in addition to that, and all of the indicators, John's provided 4 methods, trading methods that you can use out of the box. You can system test them. The method we were looking at on the Dow Industrials was method 2. But he's got 4 different methods that you can kind of apply to your trading. If you just kind of want to use some very, very sound technical systems, you can apply John's method straight to a chart. You can test the ideas, anything that you pretty much want. We've just released an update to Bollinger Band Tool Kit. So we're on version 2 right now. And I had to say that Bollinger Band, the original toolkit, is one of our most popular add-ons. And version 2 just adds so much more to an already impressive package. I mean, the amount of indicators that you get. It is a full implementation, so you can scan. With MetaStock, you can scan and find stocks that kind of have those patterns that I showed you earlier. There's an expert advisor, so if you attach one of the methods, you can get highlights and symbols and alerts on your chart, and even that expert advice that gives you kind of some guidance in terms of what you can do. And you could go in there and actually test the trading ideas, see how they work, see what stocks work best with what particular securities. I always try and do like a full implementation with our power tools, because it really does kind of allow you to take his work and really implement it with some solid technical analysis and really do whatever you want with it. So this is just a chart example. This is an example of the commentary that I was talking about before. And again, if you get a signal because you ran a scan, you're going to have kind of some trend recommendations, whether it's strong or weak, and some very, very specific instructions in terms of what you could do to take advantage of that signal. And these stops will update every bar. So if you're kind of following that, maybe you get into a long position, every bar you're going to have a new stop position and where you can put your stop at. Okay. This just shows the scanning. This was, I scanned, actually this This scan was done on October 5th, but Walmart came up out of what I had actually scanned for. So it allows you to focus on the opportunities, gives you really good advice in terms of the opportunities, ton of indicators, probably our most extensive add-on available. Just that list of indicators that are available, including like intraday intensity, bandwidth, percent B, all of those things are all kind of included for you. The add-on itself is $49 a month. What we're going to do today is if you already have MetaStock and you want to get the Bollinger Band Tool Kit 2, if you pay for a month, we'll let you pay for it for 3 months, just like what we're doing with like the MetaStock trial. So by doing that, you pay $49 today. You can kind of go in, explore the tools, see how you like them. And if you don't like them, you can cancel your subscription at any time. I would suggest that you will like them. And it is a massive toolkit. We named it Toolkit for a reason. If you're somebody that likes John and what he's done and his analytics in the marketplace, this is a very, very comprehensive collection of all of his tools. So to take advantage of that, or to talk to our sales guys, you can give us a call. The phone number is 800-882-3040. You can also chat online with us at metastock.com/saleschat. I know there are some questions that are coming in. I can see them in the corner of my eye, and I will answer those questions by chat in just a minute after we get the next session going. You can also take advantage of the Trader's Toolbox. It includes the Don Fishback add-on that we were talking about just a little bit earlier. Is $399 by itself. We'll include that, 3 months access to John Bollinger's Bollinger Band Tool Kit, a copy of MetaStock. I'll be doing a special training session the day after Valentine's Day, February 15th, at around 6 o'clock Eastern, where I'm going to go in and actually kind of train you on MetaStock, kind of give you tips and tricks. It's a total training session. I really want you to kind of understand for yourself why MetaStock's been rated so highly for like 24 years in a row now, #1 in its price category. And then we'll also include a Unleash the Power of MetaStock course that's all online as part of that package. Normally that would cost you $921 total. You can order all of that for $399 with our end of day. We call it our DC version of MetaStock. You can also get our full real-time package. If you want to upgrade and get that on a real-time basis, it would be $590. So to take advantage of that, again, you can call 800-587-8016. If you're international or you want to chat online so you can listen to the next presenter while you kind of talk to somebody, metastock.com/saleschat. We've got a couple of guys here that are ready to kind of answer your questions, send you more information, anything that you want, really. Okay. Oh, let me give that number one more time, 800-587-8016. So let's go ahead and kind of talk about Modern Trader. Modern Trader is the sponsor for today's event. They've been doing it since 1972. Great magazine. They just sent me about 5 or 6 magazines in the mail, and I love their covers. Each one of them has a little bit of a different saying down here that is very, very interesting. They provide market perspectives, insights, and recommendations. They have about 53,000 subscribers. What they're offering for you today is a no credit card required 4-month digital edition of their magazine, which is an incredible offer. And I'm going to paste this link in the chat box. We've had a lot of questions from people saying, well, what promo code do I use? It should fill in the promo code for you. But if it doesn't, for whatever reason, the promo code that you'll type in is just promo, all lowercase, and it'll take it. I've tested it. It works fine. So I'll paste that into the chat box in just a second here.